Have you ever entered into a trade only for your stop loss to be hit moments later because of a massive wick or candlestick that seemingly appeared without any indication of it happening? This is what the ICT method allows you to avoid. ICT stands for Inner Circle Trading and was developed by Michael Huddleston to find the perfect point to enter into a position. However, since ICT concepts are advanced, many videos on the topic are very long or hard to understand. So in today's video, we will be explaining exactly what ICT concepts are, how you can use them, and showing you a profitable strategy that uses ICT concepts. Traders who use the ICT method analyze the 24-hour sentiment in the financial market, starting from the Asian trading range, to identify the intraday price sentiment. The sentiment in the financial market is further influenced by market manipulations in London and New York, completing the market's sentiment cycle. The ICT method also incorporates several other key elements such as order blocks, fair value gaps, liquidity trading, imbalances, and market structure breaks. This may all sound very challenging to apply to your analysis, so let's head over to TradingView and build a simple strategy around these concepts to simplify the process. Let's first change the time frame of the chart to the 15-minute time frame. Now let's add the indicator that we will be using to the chart. Navigate to the Indicator Search tab and search for the Asian Range indicator. Select the indicator made by Nico and add it to the chart. We will be keeping the indicator settings the same. The indicator plots the highs and lows from the Asian session, the lower line on the indicator showing us the Asian lows, and the upper line showing us the Asian highs. Now let's take a look at how we will be using the indicator. Let's first draw lines on the chart to make it easier to see. We will want the following to happen. First, the price will need to move up to the Asian high. This will cause shorts to be liquidated, meaning that liquidity will be grabbed. Once this happens, price moves back down again to the Asian lows. This may seem simple, however, this is where most people mess up. To ensure that there is a valid liquidity grab, we will do the following. A liquidity grab will usually have two forms, either a candle that breaks up and then immediately reverses back down, or a wick that breaks up to grab liquidity and then immediately reverses again. This means that if the price were to break above the high and make a retest before reversing back down, this wouldn't be an ideal setup and thus we'll ignore it. Of course, the opposite is true when price grabs the liquidity in the lows of the Asian session. If there is a candle or wick that instantly reverses, we will consider it a valid liquidity grab. However, if the price were to break below the lows and retest the low resistance before heading back up, we will ignore the setup since it shows that there still might be a bearish bias in the market. As you can see here, we see an example of an ideal liquidity grab. We see that a wick grabbed liquidity at the Asian high, and along with this, we also see that the price has instantly reversed. However, before we start looking for an entry, we will first need to see a break in the structure of the price. This means that instead of there being a higher low, we will wait for a new lower low to be created. As you can see, this occurs here, meaning that a valid signal has been given. This will be the method we will be using to spot the signals. Now let's take a look at how we will confirm these signals and find the exact time we want to enter into the position. Here we see another setup that meets the requirements we previously mentioned. To confirm and find the exact point to enter the position, we will switch to the 5-minute time frame. After doing that, we will be using fair value gaps to find the point at which we will enter into the position. A fair value gap shows us imbalances in the market. The easiest way to spot a fair value gap is by looking at the price action. Fair value gaps occur in a sequence of 3 candles, where the wicks of the 2 outer candles don't fully overlap the large candle. The part where the candles don't overlap is the fair value gap. If we go back to the chart, we can see that a fair value gap has been created here. This is because the wicks on the outer candles don't fully cover the middle candle, indicating that there may be an imbalance. Let's plot a line here so that it's easier to see. We will enter into the position once the price reaches the fair value gap. We'll also need to make sure that the price fills the gap, meaning that the price needs to reach the upper line. This occurs here, so we would have entered into the position. We can see that if we would have entered into the position, the trade would have been very profitable, but there are still some entries that you shouldn't take. As you can see here, we will not be looking for an entry. This is because even though price did reach the Asian lows, the price proceeded to go even lower instead of making an instant reversal. Now that you know exactly what we will be looking for to enter into a position, let's combine all of these signals and take a look at when to enter into a buy position. But before that, if you are looking for a broker that has extremely low commissions and spreads, then check out Henko Trade. The best broker to trade forex, indices, commodities, or crypto. They have live chat support so that any questions you may have can be quickly and easily answered. One of Henko Trade's most prominent promotional offers is the matching deposit bonus that can be claimed when you open an account with Henko Trade. Sign up via the link in the description to register with Henko Trade and get access to all of these perks. First, we will take a look at the price action on the 15-minute time frame. We see that there was a bearish liquidity grab, however, the price has already fallen to the Asian low, so instead, we will look for a bullish liquidity grab. A few candlesticks later we see that a bullish liquidity grab occurred. To make sure that the grab is valid, we will check and make sure that the price instantly reverses after this liquidity grab. We see this happening here. Secondly, there will need to be a break in the structure. As you can see, this occurs here, meaning that a valid signal has been generated. Once this happens, we can switch to the 5-minute time frame to look for the exact entry that we will be taking. On this time frame, we will be looking for the lowest fair value gap, meaning that we will be looking for 3 candlesticks where the wicks from the outer candlesticks haven't fully covered the body of the middle candlestick. We see this happening here. Now that we have spotted the fair value gap, let's draw a box around it and wait for the price to fill this gap so that we can enter into the position. As you can see, this happened here. Now let's enter into the position. We will be placing the stop loss at the recent swing low. This will usually be near the liquidity grab. For the take profit, we will target a previous resistance point, aiming for a risk-to-reward ratio of at least 1.5. Now let's see how the trade plays out. For a sell position, we will first change the time frame back to the 15-minute time frame. As you can see here, the price first went towards the Asian lows, meaning that we would look for a buy position, but since price didn't instantly reverse above the lows, we will ignore the signal. However, after that we can see that a bearish liquidity grab took place. This means that the price moved to the Asian highs, grabbing liquidity, and then immediately reversed. To validate this signal, we will need to take a closer look at the price action. A clear break in the structure of the price will need to have occurred. We can see this happening here, meaning that the second condition has also been met. Now that we know that the signal is valid, let's switch to the 5-minute time frame to find our exact entry point. First, we will be looking for the highest fair value gap. As you can see, a fair value gap was created here since the wicks of the outer candles don't fully overlap the middle candle. Now that we have found the fair value gap, let's draw a box around it and wait for the price to fill the gap. As you can see, this happens here, so we will enter into the sell position here. We will be placing the stop loss at the recent swing high, which will usually be near the price where the liquidity grab took place. For the take profit, we'll be targeting a recent resistance point, aiming for a risk-to-reward ratio of at least 1.5. Now let's see how the trade plays out. I hope this video helped you better understand what ICT concepts are and how they can be integrated into a strategy. If you enjoyed the video, please subscribe to the channel and leave a like so that we can keep creating these free videos.